Good morning, everyone. You are watching live Daily Market Outlook prepared by Windsor Brokers for Monday, 21st of May 2012. We're at the beginning of a new week with some positive sentiment establishing in the markets, especially in light of the latest G8 meeting where some still rhetorical support was given to especially to the Greece. That was actually the main fear of the Eurozone members as the recent elections resulted in parties that were not supporters of the current austerity plan winning the elections, and the likely scenario was for Greece to leave the Eurozone. That would have quite bad consequences for the rest of the members and for the bloc on its own, as the other countries such as Spain, Italy, Portugal were the next, and in current debt crisis, the domino effect would be the likely scenario. For now, the world leaders on their meeting backed keeping Greece in the Eurozone and want to take all steps necessary to combat financial turmoil while revitalizing a global economy increasingly threatened by Europe's debt crisis. A summit of the G8 leading industrialized nations came down solidly in favor of a push to balance European austerity, an approach long driven by German Chancellor Angela Merkel, with the new dose of US-style stimulus seen as vital to healing ailing Eurozone economies. But it was clear for now that divisions between the members remained. The comments of the members of the G8 meeting said that they are all committed to do and to take all the necessary steps to strengthen and reinvigorate economies and, of course, combat the financial stresses, recognizing that the right measures are not the same for each country. The leaders said in a joint statement issued at their meeting at the Camp David in the United States. The overcharging message from the summit hosted by President Barack Obama reflected his own concerns that the Eurozone contagion, which threatens the future of Europe's 17-country single currency bloc, could hurt the fragile U.S. recovery and his re-election chances in November. With Greece's political and economic upheaval high on the summit agenda and stoking concerns over instability in Spain and Italy, G8 leaders sought to calm the situation. In the first line of their financial economic communique, they essentially endorsed calls to broaden Europe's focus beyond the German-backed fiscal belt tightening, calling it our imperative to promote growth and job creation. Anxious to quell investors' fears, the G8 said, "We reaffirm our interest in Greece remaining in the Eurozone while respecting its commitments," but leaders offered no specific prescription for extracting Athens from its worsening crisis. It was unusual for the often bland G8 communique to single out a relatively small nation, but fears that the political stalemate in Greece could lead to its departure from Europe's monetary union at unknown costs to the financial system and global stability have spooked the markets. From the side of Greece, there were some positive comments as the leftist leaders announced basically yesterday that they are ready for some talks about austerity plan, meaning that the worst period should be behind us, and some more talking and compromising in the current situation would be giving some results. As no economic indicators due today in our calendar, we'll be focusing more on the situation in the markets. As said, there's some positive sentiment has been established in single currencies movement that hit fresh 4-month low last Friday, with some more positive action expected, backed by current comments of G8, bringing investors back into the more positive action with euro, and as the pair bounced from last Friday's low and regained the first barrier at 128.00. However, from the other side, sterling is still under pressure despite some brief recovery, while the dollar yen shows similar action. Some brief corrective action so far didn't give any significant results, with the dollar Swiss currently in the corrective mode after hitting 95 level. The biggest gains were seen on gold that bounced to 1600 level. This was our initial target from our past few sessions, when I said that we need to see minimum 1600 to be regained in order to improve the current situation that drove gold to the very strong longer-term support and double bottom at 15.2232, with current bounce higher seeing more prospect for further gains and recovery, with the crude oil still being under pressure, as the latest action seen this morning pushed the price down to as low as 91.11. This is the lowest so far since October 2011 approximately, and more to come as a negative tone continues to drive the energy prices lower. We're going to now take a look in each instrument on its own and see the current technical outlooks and the expectations for today. As always, starting with the euro. As we can see, the latest past 3 weeks down move from 132.82 peak of 1st of May 2012 dipped as low as 126.41. This was the low of last Friday, when the temporary ground was found so far, and the brief recovery above 127 and above 128 so far tested the descending trend line of 132.82 through 131.77. That is at 128.11 on the the pair so far recovered approximately 23.6% of the entire move lower, with the further bounce through 128.37, where is the 55 days exponential moving average, and the static barriers at 128.68, along with the Fibonacci 38.2% at 128.86. At this point required to improve the current situation, as the hourly studies are in the positive territory, and some corrective action was seen on already overbought conditions. Good potential is seen for the further recovery, as long as our initial supports at 127.50-60 zone and the lower ones at 127.30-40 are intact and containing dips that will open way for a fresh leg higher, with for test of previously mentioned levels at 128.68, 128.86, with the regain of very significant 129 level to confirm the temporary bottom and base at 126.41 and allow for a stronger retracement of the down move from 132.82 to 126.41. A break above 129 and the 129.60 that marks 50% retracement, along with the 129.80 static resistance would be more confirming the positive short-term structure and allow for a stronger recovery, with the regain of 130 zone as the next psychological barrier, expected to confirm an open way for a further extension. On the larger time frame, the negative tone continues to dominate, especially after the pair lost its very significant supports at 130.00 and 129.50, and the accelerating losses after losing these levels, with the focus still at 126.22 yearly low on the larger picture, as studies are still negative, but some signals of corrective action are seen in the daily chart, and the break above previously mentioned the levels is required to confirm, as the daily RSI now is emerging above its out of its negative and oversold territory. Possibilities are increasing for a further recovery and the corrective action of the latest down move from 132.82 that bottomed at 126.41. However, as long as the technicals gave some support to the overextended conditions of the pair, and the presence of very strong support at 126.22, that wasn't expected to be cleared at once, along with the positive news and fundamentals coming during the weekend from the G8 meeting. I think this is quite a good ground for some short-term corrective action for the pair. Of course, a lot depending on the steps that world leaders are going to take. As I said at the beginning, this was so far rhetorical and a good idea, but this needs to be materialized in order to give us some more firm results. And of course, a stronger action would be quite supportive for euro that is weakening in the past couple of months, and significant losses are seen from beginning of 2012 as the pair dropped from its levels close to 135 to the levels close to 126. So just to resume, the near-term outlook sees potential for further extension higher, with the 120 break above 128, 128.11. That was the overnight's high, facing a 128.68 static resistance and 128.86 Fibonacci 38.2 break, of which to open a way for a stronger recovery, and towards 129.00, our next very significant target level and psychological resistance. The cable is in the near-term recovery mode of last week's fresh low at 157.31. Not much seen so far, as the gains were limited above 138, high of 158.37 seen so far, and gains limited, as I said, by 55 days exponential moving average on the hourly chart, as well as 200 days moving average on the daily chart that was broken a couple of days ago, and so far limiting the upside. Break above this level is required to open way for a stronger recovery, with a first Fibonacci level at 158.65, along with the 20 days exponential moving average acting as the next barrier ahead of 159.00 and 159.50, where is 38.2% Fibonacci retracement of the down move from 161.22 down to 157.31. I would say not much to be expected from the current action, as the hourly studies that briefly broke above their midlines and signaled some stronger recovery are now losing ground again, and the loss of the initial bullish momentum sees risk of further reversal, while the 4-hour studies remain firmly in the negative territory and see no prospect unless break above initial barrier at 158.40 zone and break above 200 days moving average would signal a stronger recovery. From the other side, the larger time frames still keep the firmly bearish tone, despite approaching oversold territory, with this risk still seen on the downside, as the pair briefly broke below 50% retracement of the entire move from the yearly low at 152.33 to 163.00, and the loss of 157.31 low of last Friday to open 157 as psychological and round figure support, ahead of more significant mid-February lows at 156.40 zone, as well as 61.8% Fibonacci retracement, and a higher low of 12th of March 2012 at 156.00. As said, only break, firm break above 158, sustained break above 158 had a 200 days moving average, and regain of minimum 159, 159.50 would give some more significant results in the current recovery attempt. Otherwise, risk would be seen towards the downside as a part of the larger descent from 163.00 with targets 157.30, 157.00 and 156.40 zone. The dollar yen is in a mild corrective action of its recent low at 79.00 posted in late hours of last Friday. This was our initial target. This is basically the peak of post-intervention, one of the low highs of the post-intervention period in October 2011. 79.52 was the initial one, and then 1st of November 2011 was the next level with the still negative outlook on the lower and larger time frames, keeping the downside still quite vulnerable, and sees risk of further extension lower as the initial corrective action so far holds below our initial resistance at 79.45. These were the highs of last Friday. Immediate risk is seen towards the downside as current movement are seen just as consolidation before fresh leg lower. The last week's sharp descend through 80.00 support and the test of 79.00 keeps the prospect in play for further extension lower, as test of our target at 79.00 now sees a risk of further extension with the 78.50 200 days moving average seen next ahead of 78.30 zone highs, 78.30 zone highs of November 2011 seen as the next targets. To avert immediate downside risk, we need to see a regain of minimum 80.00 to confirm a temporary base at 79.00 and allow for a stronger recovery. Otherwise, quite a negative scenario would be retest of 79.00 and further extension lower. Only break above 80.00 and regain of more significant static resistance at 80.54, peak of 16th of May 2012 would provide relief and allow for a stronger recovery. As said, the negative tone dominates on the larger time frames, and the brief false break above the main bear trend line and the steep reversal lower keeps the focus at the downside and the weak outlook for dollar yen for now. The dollar Swiss also said is currently in the corrective action after last week's rally extended to 95, 0094.99 was the highest posted on last Friday. This was our initial upside target that was reached, and then the pair entered the corrective action as the studies on the 1 and 4 hours charts were overextended and in overbought territory. That signaled the corrective action. Dips have so far reached 93.73, just below 23.6 first Fibonacci barrier, with more significant supports on the downside. First 55 days exponential moving average at 93.53 and Fibonacci 38.2 at 93.24, and the most significant 93.00 level needed to stay intact in order to maintain the short-term rally of 90.41 to 95.00 and keep the bulls in play for a fresh attempt higher. Break above 95.00 to open 95.45, peak of 15th of December 2012, and the yearly peak of 9th of January at 95.93. That are our next upside targets. as said, only loss of 93.00 would be quite would be affecting the pair's short-term price action, as this will trigger fresh weakness and a stronger correction of the latest 90.41 to 95.00 rally, with the 92.70 50% retracement seen next on a potential break below 93.00. As mentioned in the introduction, gold was benefited, actually the top performer of the last week, as it's bounced from a critical support zone at 15.26. This was the low of last week, extended the corrective action to 16.00. That was our initial upside target, and the 50% retracement of the latest down leg from 16.71 to 15.26. With a firm break here, that is currently acting as quite a strong barrier, and some corrective action is seen following last Friday's and overnights hitting this level. Break above this level, and regain of next Fibonacci barrier at 61.8% at 16.16 is required to confirm the bottom at 15.26 and open way for a further retracement. Negative tone is still seen on the daily chart, as studies are still well below their midlines, but current bounce sees potential of stronger recovery, as for now the critical support and very strong support zone at 15, 20, 30, which are the double bottom of September 2011 and December 2011, as well as a recent low of last week, is looking for creating a base here that will be marking actually triple bottom, and that will be quite good support for the yellow metal to bounce higher. For now, regain of weekly 90 days moving average at 15.53, and the regain, as said, very important 1600. The level is required to confirm the positive structure that exists on the lower time frames and will allow for a stronger recovery. Overbought conditions on the 1 and 4 hour charts are now looking for a corrective action, with some signals already seen on our hourly studies, with initial support on 20 days exponential moving average at 1591, ahead of next static support at 1585 and 1580, which will be basically our initial support that should contain dips in order to maintain immediate bulls in play, basically down to 1570, where it's 38.2%, as well as static support low of 80 of last Friday at 1567, expected to contain dips in order to maintain the current positive structure. Reversal at above these levels, as said, will keep the positive tone for further extension higher, with the break above 1600 to open 1616, 61.8% retracement, and 16 next barrier at 1624 zone seen on the break. Only loss of 1570, 1567 would be risky, as this would weaken the tone and allow for a deeper reversal. For now, positive structure keeps the upside, the near-term upside in keeps the near-term upside targets favored. And a quick look at the crude oil that extended its recent weakness of the yearly peak at 110.53. 91.11 was the lowest so far seen this morning after the opening of the markets, with some corrective action, consolidative action actually seen for now, with the bounce above 92, currently trading at 92. 92.30. Initial dynamic barrier on the hourly chart 92.68 is the 55 days exponential moving average, ahead of 93 and 93.22 high of last Friday. Basically only regain of Well, difficult to say at this point. Only a gain of, I would say, 96.40, whereas 200 days moving average would prevent the oil price of further strong losses, and would be signaling some stronger recovery action with the regain of 100 as our reference and the psychological barrier to confirm the bottom at levels where the oil is now, and would tend to focus higher. Comments from the major world producers that $100 per barrel price is suitable, especially for the Saudi Arabia that took over Russia after a number of years, becoming again a top producer as this March production of oil reached its maximum. Would be considered as also the current crisis with Iran are keeping still a risk of further gains of the oil price, with the recent losses seen on the fears of lower demand due to the crisis in Europe. Once the steps will be taken in solving Eurozone problems and the first signs of recovery of the US economy, would be a good signal for the oil prices to start bouncing higher. That was all for today. I would like to thank you all for attending our live sessions. We are back tomorrow morning at the same time at 7:00 GMT. For all those that missed any part or missed the session, this session will be shortly uploaded to YouTube. Windsor Brokers page is called Windsor Brokers Forex. Until tomorrow, I wish you a nice day and very successful trading. Good luck.